In this week's update, US earnings remain a tailwind. But what about inflation? And are precious metals proving the experts wrong on inflation? My name's Garry Davis, and as always, this is general advice only. And please remember to like and subscribe to the video. All right, let's start with some market perspective. There's a lot of talk these days about inflation. I think it's probably the biggest concern of the market. And no one really knows whether inflation is going to be a problem or not. If you look around you, I think everyone appreciates that inflation is higher than what the official figures are saying. You've just got to look at what everyday costs are to know that that's the case. So the inflation figures are pretty much managed or manipulated to say something a bit more friendly to the governments, whether it's in Australia or America or where it is. So inflation is real. It's rising. We saw a 6.2% figure in the US through the week, which is the highest in quite some time. But the debate is whether this is just transitory because of supply chain issues and will just ease itself back down again in the future. Now, at the moment, the bond market and the Fed are saying that it's not a problem. But there is a possibility that it is a problem. I don't know whether it will become so or not. But one thing that you can do, rather than feel like you've got to go and hide because we're going to end up in stagflation and the sky's going to fall in and the stock market's going to collapse, the things that you can do are buying into stocks and sectors of the market that can deal well, in fact, can prosper quite well from inflation. So, to me, it's a matter of focusing on growth and growth in companies, which is going to happen whether we have inflation or not. So let's step aside from the debate. Let's step aside from the risk and just be in areas that are going to work well with or without inflation. And if you look at commodities, both hard commodities and also soft commodities in the agricultural space, but particularly in the battery materials area, the demand for battery materials is going through the roof and is going to remain so because the entire society is now focused on decarbonisation. So that demand and buoyancy in prices is going to continue. But if inflation starts to ramp up, then those prices and the pricing power of those companies is going to rise anyway. So they're going to be protected to a fair degree. Precious metals is obviously another area that is an inflation hedge, and so that's an area where we're starting to see a bit of a sign of life, and I'll come back to that. The next area is businesses in all sorts of areas, but predominantly in technology that have got pricing power. So even if inflation does become more of a reality than it is at the moment, if you're focusing on businesses that have got the ability to raise their prices, that have got asset-light business models, then they can continue to do quite well whether we have inflation or not. So to me, the answer is not, am I in the market or am I not in the market? It's a matter of be in the market, but be in the areas that reduce your risk if inflation does become a problem. Let's turn to American stocks. The S&P did fall just a little bit on the week, but with quite a nice recovery into the end of the week. I wrote covered in last Sunday's video that the market was pretty high and that we would see some sort of correction, but it would probably be pretty mild. And so far we've had a couple of days down. They don't tend to do very much, as we'll see from the charts, and it may well be that we'll just get a reasonably solid, buoyant period into the end of the year. Now, the earnings season is pretty much wrapped up now in the States, and 81% of the S&P 500 stocks have beaten on earnings. The long-term average is around 76%, so that's comfortably above the average, and it just points out yet again that the market is rising on earnings, and I keep banging on about this every week, that stocks Some stocks are getting overvalued for sure, but many stocks are not. Many great stocks are not getting overvalued. And I think it was 2 weeks ago I did an exercise looking at Microsoft and how the valuation today sat in terms of their earnings growth and the environment that they're in. And the conclusion was that Microsoft is, as one example, is not overvalued. And when you've got 100 other similar Microsoft type stocks, it's no wonder the S&P is as buoyant as it is. Secondly, the growth outlook. So not only the results that were achieved in the third quarter, but also the growth outlooks for these companies remains pretty buoyant. So you've got to say there isn't really anything there from a fundamental point of view that is going to bring this market down significantly, other than just a bit of overvaluation. But the question is, will the environment change? So the current environment is low interest rates, inflation under control, and still heavy stimulus. Now the question is, will that environment change? And again, no one knows the answer to that at this point in time. It's something we need to be alert to, but we can insulate ourselves from those changes by the type of stocks that we own. The US dollar has now clearly broken out above that resistance, and it was at 95.12. I think the resistance that I've been pointing to for months was at 94.7. So we're clearly back into uptrend out of that range. The 10-year yield was down about 1.45 last week. It did sneak up during the week, and that's probably a reflection of what's happening with the inflation data. But that didn't worry the market. The VIX is still steady at 16.3. Stocks are still doing what they've been doing for a long time. So things are still looking pretty stable in the American market. So let's go and look at some charts. This is the S&P. You can see we had some selling on Tuesday and Wednesday, steadied on Thursday, and then quite a nice recovery on Friday to end the week again on a pretty good sentiment. But looking at the S&P on its own can be very misleading because it's just such a broadly based. It's an index that is dependent on what major stocks are doing. The biggest market cap stocks have the biggest impact. So that's why I like to track a whole lot of other charts in the US market to give me a better idea of what the breadth is in the market and what the bulk of the stocks are doing. And this is a good one. There are many others, but MDY, which is an ETF that tracks the small cap 400, the mid cap 400 stocks, and you can see we're in a trading range for quite some time that went back to around April. So around about 6 months of sideways trading range. Clearly that's broken out and continues to track higher and on good volumes as well. That breakout was on very good volumes. So when you're seeing market breadth like that, this is not just about the major stocks advancing and getting more and more overpriced, which is what a lot of the narrative that's coming out of these days. This is really what's happening in the US market. And then, of course, we always want to look at the spreads. This is consumer discretionary versus consumer staples. Bit of a pullback during the week, as you can see. So, but a good part of that was the fact that that Tesla fell, being in the consumer discretionary area. So that did have an impact on this ratio. But clearly, still we're in uptrend there. This is the US small cap growth versus small cap value stocks, and it's really just tracking sideways. And this is the larger cap stocks, so the 1,000 growth versus 1,000 value, and clearly that's still looking in pretty good shape. So that's the US market. If we look at the currencies, So there was the key 94.6, 94.7 level, and the US dollar has managed to break out of it now. Higher highs, higher lows, so clearly trending to the upside. And it's very interesting that, or very telling, that the gold price and the silver price went up despite a breakout in the US dollar. Now, if we look at the Aussie dollar, so quite a sharp turnaround on Friday, which perhaps is a reflection of commodity prices remaining in pretty good shape. So the Australian dollar finished at 72.84, but it's really still just in a range. It's really hard to pick the direction of the Australian dollar at the moment. There's so many opposing forces that are washing it backwards and forwards. Turning now to the Aussie stocks, so our index fell 0.2% for the week, but one would think at the index level probably a bit of a gain to start on Monday. Now again, another thing that's been happening in the media commentary is the hunt for the next big theme is on in a major way. Battery material stocks have done brilliantly well. Some of them have gone up very, very substantially, and so naturally people start to get worried about that they've run too far too fast, and they start looking for the next big theme. And what's been put forward in recent weeks is hydrogen keeps coming up, helium is another one that's getting some airplay, magnesium also because of issues in China. And also potash, of course, as well. So I don't know when those sectors are really going to get the acceleration that we saw in lithium, for instance. But there's certainly areas that are worth keeping an eye on. So let's have a look at the Australian indices. We'll start with the XMJ, so this is the large material stocks, largely BHP, Rio, Fortescue, and we saw quite a decent kick up on Thursday and Friday, so iron ore stocks did quite a bit better. If we look at the small cap index, it is in a range. It's been in a range since early September, but sits near the top of that range, so certainly small caps aren't losing any ground. If we look at the overall ASX 200 index, it's really just sitting at the same level we were at in June, so it's gone nowhere in the last 4 or 5 months. And that's largely because we're just getting a lot of backwards and forwards, with the healthcare majors first of all. The banks have sort of lost their upward momentum, and energy has been all over the place. Energy had a real spurt, and now it's given nearly half of it back again. So certainly some conflicting things happening there. Just while I'm here, this is the Bitcoin chart. So we got a breakout to new all-time highs, and it's still sitting around about that breakout level, which is around 64,000. Now turning to precious metals, this is gold on a weekly chart. I've been showing you this downtrending channel for some time. So two things happened last week. First of all, the price broke out of that channel. And secondly, we started forming higher highs. So we're yet to see what the next dip looks like, where it pulls back to. But if it forms a higher low, then we've got definitely a change in character in the gold price. Just zeroing in on the daily, you can see it was consistently higher. It was quite a concerted move throughout the week. There wasn't a single day that's been down in the last 7. So certainly the gold has come back into favour, and silver is pretty much tracking along in the same way. Now, if we turn to the gold miners, I'll focus on GDXJ, which is the junior ETF, but really it's more about mid-cap and even some what we would call large-cap gold miners in there. It's just not the super majors, which is GDX. But again, this is a more broadly based index that I think is more reflective of the sorts of gold stocks that most people tend to own. So you can see that we've broken out there. It's not particularly robust at this stage, but I think if we get above this just a little bit higher than where we are now and start to break into new territory, then we could start to see a real surge of interest back into gold stocks. Just finally on the Australian scene, so there is a lot of focus now on looking for alternatives, the next big major theme, but don't lose sight of the things that have been working so brilliantly well in the battery materials space. You know, they're still there. They're still advancing nicely. They're getting a bit volatile, and we're getting some sudden pullbacks. But you can take care of that with a game plan. You know, you don't have to avoid the sector. Just learn to manage your exposure to it. So just a quick summary on precious metals. Gold was up $47 to $18.65, despite the fact that the US dollar went up. So clearly inflation is higher than what the official numbers. I read something this morning that said that in the US, they used to include house prices in the inflation data until 1983, and then they probably found it an inconvenient truth, so they just took it out. And this is how the inflation data has been getting managed by governments around the world for decades. Now, the Fed is saying that higher rates or the higher inflation is transitory. The bond market is saying something similar because it went from 0.7 to 1.7 in 2020, but now we're still sitting at about 1.5. So the bond market doesn't seem to be concerned. But gold is now perhaps starting to say something else. So gold is well worth being back on the radar again. And the precious metal stocks just showing a few signs of starting to lead the metal. All right, turning to other commodities, copper was up just a fraction to 453. Nickel similar, but again that's quite good performance considering the US dollar breaking out. So the question is how to exploit the next decade, because clearly we're in some sort of, I won't use the word super cycle, but certainly we're going to be into a very strong period for commodities for the next 5 to 10 years. And I was saying that back in 2019 and certainly into 2020 that would be the case, because that's just the way the big picture cycles work. We were due for a very strong decade of commodity prices. Decarbonisation is adding to that enormously, but that cycle was going to come anyway. So the question is how best to exploit the next decade. And it's really just about being clear on your game plan. And I hope I'm not boring on this, but it's just so important. You get clarity around how you want to operate and what you want your portfolio to look like, and everything else just slots into place. It's not rocket science. Now, crude oil rose again, dipped a bit under 81 last week or the week before, but back above 81, and it's really hard to see a return to low oil prices, because there is just no appetite for investing in the energy sector. In fact, it's being actively discouraged. Banks are now refusing to lend for oil and gas development. Yet the demand for oil and gas is not going to suddenly fall through the floor because everyone wants to decarbonise the planet. There's just too many things that require oil and gas. So the demand is going to stay. The underinvestment to raise supply, and a lot of major oil fields are depleting. So the underinvestment to replace that depletion is just not happening. So I think you've got to get used to the fact that oil prices and petrol prices are going to remain high, and that's going to feed through into all parts of the community. So there's the spot copper chart. Nickel looks pretty similar. Not a lot happened last week. So wrapping it up, As I said last week, just keep doing the simple things well. Just try and shut out the media. Just be clear about what you want. Don't try to outthink the market. Looking at tops and starting to see things that you think should be there that aren't really there. The very best businesses, like the Microsofts, will fall less than most of the market, and they'll rebound the fastest. So there's an area that that you can do, I think, quite well out of, even if we do get corrections from time to time in the market, or I should say when we get corrections from time to time in the market. So just be clear about what you want your portfolio to look like, how you want to operate, and just stay focused on doing the simple things. Portfolio analyst last week, we had one of our early stocks has just crossed the 10 bagger threshold. That was which was pleasing, I feel comfortable that there's more coming. And the other thing that we dealt with, again, just so important, is about creating and executing a game plan that's suitable for you. And there definitely is no one size fits all here. It's just a matter of some clear sequential thought about what is important to you, and then putting that game plan together and being disciplined in its execution. That's it for this week. There's more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.